let's look at some of the recent economic news that will be driving the markets this week, as well as what to look forward to data-wise this week. So just to start off, economists see lower recession risk and stronger job growth, this Wall Street Journal survey shows. So economists expect stronger growth in job creation, lower risk of recession, and cooler inflation than they did just 3 months ago, according to this Wall Street Journal's quarterly survey of professional forecasters. On average, they expect gross domestic product adjusted for inflation to grow 1% in the fourth quarter from a year earlier. That is up from an April forecast of 0.8%, but just half of what they expected in January. They see growth rebounding to 1.9% in 2026, little change from prior surveys, and on average, they put the probability of recession in the next 12 months at 33%, down from 45% in April, but still higher than January's 22%. The survey gathered responses from 69 economists at outfits ranging from Wall Street banks to universities to small consulting firms from July 3rd to the 8th. So that was just a couple weeks ago. The improved outlook follows 3 months of generally encouraging economic data. They highlighted job growth being pretty well, holding up pretty well as the unemployment rate dipped rather than increasing like a lot of people thought it would. Weekly claims haven't been coming in too alerting. Business and consumer sentiments holding up pretty well. And then the stock market's been doing pretty well, with the S&P 500 notching a record high this month. It's just been going up. Perhaps most important, the tariff-driven inflation spike that economists widely predicted hasn't materialized. So it showed up a little bit in the data, but not really. So all of this is seen as good news and why they're seeing less likelihood of a recession occurring. I think that's all I've gotten from this article. So more people are lowering the risk or likelihood of a recession occurring, and it kind of falls in line with what the Federal Reserve initially said, like, hey, we don't see the job market really deteriorating and a lot of people's paying attention to the job market. We suggest y'all turn y'all's focus from the job market to looking in and eyeing in on inflation, because that's what we're watching, and I'd imagine it's driven around tariffs, which we got more news on tariffs. So Trump threatens 30% tariffs on the European Union and Mexico. So the U.S. will charge a 30% tariff on goods from the European Union and Mexico effective August 1st. That's what Trump said in letters to the leaders of each trading partner posted on Truth Social on Saturday morning. Trump has made U.S. trade deficits a focus of the letters. He said he would consider lowering the tariffs if the European Union offers complete open market access to the United States with no tariff being charged to the U.S. And if Mexico does more to combat drug cartels, mainly around fentanyl, which he said are trying to turn all of North America into a narco-trafficking playground. The tariffs would hit products from two of the U.S.'s largest and most important trading partners. Taken together, the 27-nation European Union is the U.S.'s largest trading partner, with $975.9 billion in two-way goods trade in 2024, according to the U.S. Trade's Representative's Office. On a nation-by-nation basis, Mexico is the U.S.'s largest trading partner, with nearly $840 billion in two-way goods trade in 2024. So it seems Trump's still on his wagon of increasing tariffs, trying to get away from this taco trade title he's really earned himself, where Trump always chickens out. He's going to say he's going to do this, and then he's going to reduce it or walk it back and delay. And he's mentioned multiple times now that, hey, when August 1st comes and y'all get these tariff rates, we're not kicking the can down the road. That's going to be what's effective. And that goes back to whether or not this Wall Street Journal survey actually comes to fruition, and whether or not we actually see a recession, and how all of the odds play, because there's this thing called the market cycle. And we could look this up real quick. Let's do this because it's pretty essential. Let's just look up economic cycle. And then first you got to be able to spell cycle right. All right, and let's just look at some images real quick. So there's a couple different stages in the economic cycle. I like this one right here. And honestly, we could ignore GDP all entirely. Is it going to pop up though? There we go. So you could kind of see this, not really. But what you see right here is there's expansion when we're going up, then we peak out, and then we start heading down in what's called a recession, or two consecutive quarters of negative GDP is the common definition of what a recession is. And then you bottom out and then you continue the expansion phase again. And usually the market goes up and down, and it's real cyclical in nature, to where the seasons almost are great analogies of this, because in the summer, like, everything's booming, and then as you start cooling off heading into fall, that's when we start falling out. And then winter, everything kind of freezes over. So imagine the economy kind of freezing over in the winter. That'll be about the bottom. And then spring, we start heading up again. And then summer. So imagine that cycle. And remembering this cycle, and this is why I brought up this economic cycle, heading into winter is usually the slower part of the economy and slower part of the real estate cycle as well. And if tariffs kick in August 1st, and we start seeing inflationary data begin to show up in the data, so we start seeing companies have to raise prices, and it starts taking a toll on consumers and their purchasing power, there's a big old question mark as to whether this slows down the consumer spending aspect. And consumer spending drives jobs, it drives money being spread around through the economy, the velocity of money. And as long as consumers are spending and jobs hold up, there's no recession, or a recession risk is much lower. But assuming that inflationary data begins showing up and consumers start spending less, and then businesses start expecting consumers to spend less, so they invest less into property, equipment, goods and services, employees, and that just kind of trickles down to the economy. And then if everything starts slowing down, recession risk rises. And it all goes back to all of the data holding up pretty well. The stock market's been holding up pretty well. And what really happens if we start seeing meaningful inflation begin to show up from these tariff policies that Trump is implementing? And he really has to put his foot down because people aren't taking him serious. And then what happens to the Fed and their mandate? Because right now they're focusing on inflation, and they're saying inflation's mainly the key to what they're watching. And they do see an economic slowdown later on this year. But if there's this economic slowdown and a spike in inflation from these tariff policies, what does the Fed do? Because it's like, all right, we could lower interest rates to kind of stimulate the economy if the economy's slowing down. But if inflation's increasing from these tariffs, if they lower interest rates and that stimulates the economy, that actually supports inflation. That could lead to inflation coming up even higher. And what happens out of that? Do they end up raising rates again, or do they hold steady, or do they cut? So that's kind of what leads into stagflation, where there's stagnant economic growth or even negative growth with high inflation. And that's where the Fed is put into this really tough spot. Now, for stocks being at record highs and valuations being pretty expensive, all of it's determinant on what happens or continues to happen with these tariffs, if it begins showing up in the data, and how earnings season goes. So let's highlight earnings season, because this is what everybody's watching to test whether or not these stock market highs and records are worthy of holding. So investors are seeking clarity from corporate leaders about how the back and forth on trade has affected their businesses, worried it will hurt economic growth and corporate profits when stocks already look expensive relative to history. In the week ahead, investors will parse results from banks including JP Morgan Chase, Wells Fargo, and Citigroup. BlackRock, the world's largest asset manager, also reports earnings. So we got some big corporations reporting earnings this week, and this is just the start. Analysts expect profits from companies in the S&P 500 to climb 4.8% in the second quarter, according to FactSet. That would mark the lowest year-over-year growth since 2023 and a steep drop from the 13% jump during the first 3 months of this year. Analysts will study earnings and executive commentary for clues on the health of the United States consumers and their ability to weather tariff-related price increases. So we were just kind of talking that. Touch just the tip of the iceberg. Economists at Goldman Sachs estimate consumers will absorb 70% of the direct costs from tariffs. Interesting. Many U.S. companies last quarter pulled or lowered their outlook for the rest of the year, with some saying that the tariff whiplash leaves the future more uncertain than usual. Some analysts say that they expect more doubt from corporations about their forward projections this time around, and this can lead into the tariff policy and their agendas and what really happens. And analysts, let's go back to analysts, they're really watching these earnings to see if these costs are being passed down to consumers. And it's really a bad scenario either way, because it's either the companies pay or the consumers pay, or like they both pay. And if the consumers pay, that leads into demand and what companies expect demand to be like, and companies' corporate investments. And remember, that's property, equipment, goods and services, and employees. So that's a big leg of the economy. And if consumers aren't bearing the cost, then the companies are just bearing the cost, and they're making less money on the goods and services they're offering or selling. And if they're making less money, that all goes back to earnings and how these earnings are going. And if earnings aren't doing well at these stocks with expensive valuations, are stocks worth where they're at, these record highs? So several said that the solid reports and confident outlooks from the index heavyweights, whose earnings kick off July 23rd with results from Tesla, could provide another leg up for the stock rally, assuming they come in pretty positive and optimistic. Improving profits would also help alleviate one major concern about stocks' climb, that it has stretched share prices relative to corporate earnings. Companies in the S&P 500 recently traded at 22.4 times their expected earnings over the next 12 months, above the 10-year average of 18.8 times. And then they end off, I would be more comfortable if valuations were a little bit closer to a normalized environment rather than at the peak that they're at today, said Empowers Norton. So a lot of people are going to be watching how these earnings come out. A lot of stocks have been really optimistic and going up. Risk plays, we got Bitcoin reaching new all-time highs. And I was reading this other article from, I believe it was like Barron's or Wall Street Journal or it was Market Watch. And they were talking about how story stocks have really been doing well. And these are companies like Robinhood or Palantir or Tesla, and they are driven around stories like we want to reach space, or we want to help reach humanity to sustainable electricity or electric vehicles. There's these stories, and that these are the new momentum stocks, and usually momentum stocks don't end out well. So earnings will be a leading tell as to what happens with that. Now let's see what happens this week. We already talked about some of the earnings coming out. Monday is a normal non-scheduled day, so I'd imagine with nothing scheduled tomorrow, economic or Fed-wise. And we'll look at earnings here in a sec, but just on the economic and Fed speaker calendar, nothing scheduled. And I'd imagine we'd hear more from Trump or the Trump administration around tariffs, maybe some more letters that get announced. So stay tuned as to what happens tomorrow. And really this whole next week, next month, all the way until August 1st. And I'd imagine it doesn't just end there. Now, Tuesday's a big one because we got consumer price index, so CPI data coming out. This measures inflation. And we're expecting core CPI year over year to come in closer to 3%, up 0.2% from the previous reading. And this is CPI data coming out for June. So May's data for core CPI came in at 2.8%. We're expecting June to come in at 3%, so further away from the Fed's 2% target. CPI isn't what the Fed watches. They watch PCE, but CPI data leads into this PCE data that the Fed prefers to watch. Empire State Manufacturing Survey. We got some Fed governors speaking, Fed presidents speaking. Tuesday is really a busy day. Then PPI, Producer Price Index. This also leads into the Fed's PCE. So a lot of people are watching this one. They're expecting it to slightly increase. We'll see how the data comes in. It could come in a little low. It could come in way low. It could come in at expectations. It could come in high. It could come in way high. I'd imagine the way high or way low is what both the Fed and the broader market will be watching. Industrial production, capacity utilization, the Fed Beige Book. Watch that one. We got some more Fed governor and Fed president speak. Thursday, initial jobless claims. We get this one every week, and we're expected to see this one slightly increase, about 6,000 from the week prior. U.S. retail sales. We're expecting some good growth from here. So that assuming this data goes from negative to positive, that would be another good data set to clump into the economy doing pretty well. Import price index, business inventories, the Fed manufacturing survey, home builder confidence index, more Fed speak. Friday, we got housing starts, so projects being started. We got building permits coming out. These will be projects that want to start at some time in the future, and we're expecting that number to stay the same. We're expecting housing starts to come in a little bit higher, consumer sentiment, and that's pretty much what we got for economic related news. Now, let's see if I could find earnings. Usually this one doesn't give all of them, but let's just see if there's any of the mains. So we mentioned some of the mains. FB Financial maybe. All right. So Tuesday, July 15th. Yeah, that's Tuesday. So on the 15th, we got Bank of New York, we got oh wow, so we got JP Morgan Chase, Wells Fargo, Citigroup, BlackRock. Wow, so a lot's coming out on Tuesday. So Monday is really a quiet day, and then Tuesday we got CPI data, we got a ton of Fed speakers, and we got earnings from some big players in the stock market. All right, Wednesday, Walmart de Mexico, ASML, Commercial Bank of Qatar, Johnson & Johnson, PNC Financial Services, Commerce Bank Shares, Goldman Sachs, Morgan Stanley, Home Bank Shares, United Airlines. That'll tell us how traveling and the tourism space is going. Southern Plains Financial, Great Southern, AARP. What about Thursday? Right? It's Thursday, right? Thursday. So on Thursday, Taiwan Semiconductor, so TSM, Volvo, PepsiCo, Texas Capital, U.S. Bank Corp, Insteel Industries. I thought that was Industrial Steel. Some of these companies, I don't know, Bank 7, GE Aerospace, Interactive Brokers Group, Simon's First National Corp, Netflix, Kimberly-Clark de Mexico. Now let's just keep on going. So a lot of these big names, whenever you see a name that like rings your bell, like, oh, that's a huge company, I know that. A lot of people are going to be analyzing how the company's earnings came in. What are they expecting, and what do they have to say about either the economy or the consumer? So there's a lot of big names we just mentioned, like Pepsi, for example, Johnson & Johnson, those banks, 3M, that's a big one. American Express, Charles Schwab. Wow. So we got some big old names this week. So that's what we're going to be watching, y'all. And I just mentioned some of what people will be watching in on. What do they have to say about tariffs? How's the consumers holding up? Are they expecting earnings in the future to do well? What's their forward guidance say? What are some of the questions they're asking? How do they respond on these earnings calls? So that's a little bit about what we're going to be watching, what to expect this week, some of the news that'll be driving the market. I'm excited to see what happens, y'all, and I'll be here to report it every day that there's some news to talk about. So, y'all, I'll see y'all. Hopefully this video provided some value to you, and I'll see y'all next time. Enjoy the week.